Hi, my name is Daniel Odio. I'm going to show you today a tool for investors that we have that allows them to calculate cash flows and get an idea of how well an investment property may perform. I don't have my usual microphone on, so it's the audio quality is not going to be quite as good for this. I apologize, but the next one we should be back with the regular microphone. So the first thing that an investor should do to use these tools is to go to www.drodio.com/investor, INVESTOR, and that will pull up a page that we have that's just for investors. By the way, I'm going to go back to the main page. You can also get to the investor link by just clicking in this blue bar below, which I know it's kind of hard to see on the small screen, but just click on the investors tab, and that'll take you to this page. So we have a listing comparison spreadsheet, which I'm not going to spend too much time talking about today. It'll open up an Excel spreadsheet that lets you do a lot of analysis of multiple properties. I'll save that for another tutorial, but what I do want to show you today is the cash flow analysis worksheet. So you can click on this little target here, and they will open that up. Now, please read this box because I don't want anybody making any huge life-changing decisions based on this tool and then feeling like they should be holding me responsible. These are forward-looking projections and are meant for guidance only. They should not be relied upon to make your final decisions. Okay? The tax information in here, for example, is just an average. It's not specific to your situation. Please talk to your CPA before you make a final decision. So what this tool is going to do is going to help you figure out what your cash flows might be with a certain property. So let's say that you buy a rental property for $500,000 and you're planning on putting maybe 20% down. Let's say that the seller was giving you a $10,000 credit. You know, maybe that was something that was negotiated by our firm for you, which we're doing a lot these days, negotiating seller credits of even more than $10,000, $20,000, $30,000 at times. The condo fee might be $100 a month. Let's say it's a townhouse. Your GRI, gross rental income, here is going to be how much you're getting from your tenants every month. So let's say that you're renting the property out for $3,500 a month, okay? And it's 2,000 square feet. You're planning on owning it about 10 years maybe, and you're going to pay a management fee of, let's say, 7%. Now, if you're going to manage it yourself, you would change this to 0, but let's say that you want to find a property manager, and 5 to 7% is perfectly reasonable. The first trust, you can choose to pay interest only or interest plus principal, and then a percentage rate. I'm going to leave it at 7 and 9% for the second trust. With current interest rates, 7 is a little bit higher than you might usually find, but investment properties tend to cost a little more than primary residences. Now, there's a lot more to this than what's here. There are a lot of different loan types, and you should really talk to a loan officer in order to get a really good idea of what your monthly payments might be. So again, this is just a guide. Let's say that it's going to appreciate at 5% annually, and that you are in a 35% tax bracket, which would be your federal and your state taxes combined. Remember, federal taxes might only be 28%, but then you're also going to have state taxes as well. So you just click Calculate Cash Flows, and here's what you get. A projected appreciation over 10 years at 5% annually, so your $500,000 property is going to appreciate another $314,000. Your ROI, return on investment, is going to be 465%, mostly because it's leveraged money. You're not using all that much of your own money in order to realize this appreciation. If you were to put more down instead of 20%, if you were to put 50% down, this ROI would be lower because you're using more of your own money to get the return. As it is, you're using borrowed money, which means that you're using less of your own money, so the ROI is higher. So your monthly cash flow is $1,600 in this example, and we can see how we come up with that. Projected rent of $3,500. Then you have your mortgage, first and second trust is here. Okay, there is no second trust because you're putting 20% down. FYI, it's 0 on this example. Your rent minus mortgage would leave you $1,100, but you're also getting some other things. You're having other outflows and inflows. Your other outflows are a monthly property management fee, property taxes. We're assuming a tax rate of 1.2%. hazard insurance assumed as 0.2% of the purchase price, $100 a month condo fee, but then you're also getting the seller credits, which are just the first year of seller credits is defined here, so $833 of seller credits, and then you're getting tax benefits of almost $400 a month. So this monthly cash flow shows you the first year. Now, obviously, annually, after the first year, it's going to be different because these seller credits are not going to apply after the first year. And then here are your assumptions down here. So this is a great tool for you to figure out if a certain property makes sense. It's a free tool to use. And if you want to contact us to have us help you out when you're done, on the left side here, you can see a contact us box. You're welcome to submit an inquiry. We'll get back to you very quickly. If you have any more questions, please let me know. My name is Daniel Odio. I'm the owner. My number is 1-877-437-6346. Again, 1-877-437-6346. Thank you.